Hi everyone. Can I just check? Hello, hello. Okay. Hi everyone. Welcome to today's webinar brought to you by Vantage. We're gonna do crypto versus the central banks today. So, what's the differences? Today's the 16th of December. It is 5 p.m., right? Yeah. How's everyone doing? Sorry for the delay. Okay, so today's topic is going to be interesting, especially for those who want to go in deeper with crypto, you'll get a bit of an understanding on what's happening. Okay, so the disclaimer, you guys already know how this works. Hi, Nina. Hi. Hi, Tiffany, if I haven't said hi to you already. Okay, if you guys don't know how this works, I do have to go through the disclaimer with you guys. Basically, the disclaimer is a warning and a reminder that this webinar should only be construed as educational. Okay, there's nothing that I share in this webinar, nothing at all that is any form of investment advice, financial advice, or any form of signal to buy or sell. Okay, this is purely educational. I don't want you guys to be like, hey, that girl from that Vantage webinar told me to buy or sell crypto or whatever it is. Okay, I will share my own personal views and my own personal experiences, but it's not for you guys to copy. Okay, it's for you guys to think about and to help you make better informed decisions when you guys are making your trades. Okay, finally, we've started. Okay, it's working. It's working on the Vantage app. Again, there's 1,200 of you on Vantage app, and there is close to 20 of you on Zoom. Okay, so if you guys are tuning in from Zoom, I will be able to see your messages. If you are tuning in from the Vantage app, you know how crazy the chat box goes. Sometimes I will miss it. Okay, so please be patient with me. I will stay here for a minute so you guys can read through the disclaimer. Again, yeah, sorry for the slight delay. Um, it's because it wasn't started on the Vantage app. Okay, so I'm going to introduce myself. My name is Cassandra. You guys can call me Cass. I am an investment analyst and a prop trader. So I'm an investment analyst from Everest Fortune Group. We are a research firm based in Singapore. We specialize a lot in like forecasting, researching, back testing, analyzing the markets, and understanding why certain pairs move the way it does. Okay, I see the chat moving already on the Vantage app. Okay, we are a company that have been recognized as the best Forex and best equity research for multiple years running. Okay, it means that what this means is that our team is very versed and we have been recognized globally for our work. Okay, so you guys are in good hands. On top of that, because I do research and study the markets a lot, I am also a prop trader. For those who don't know what prop trading means, it means that I am someone who is funded by multiple companies. How did I get those fundings? I had to pass a few tests. Those tests usually require me to do 10% profit within a month. 10% profit for me isn't that hard. I use a lot of technical analysis and I combine that with fundamental analysis. Okay, so our agenda for today is the rise of digital currencies and CBDCs. I'll touch a bit on that later on. How Bitcoin reacts to monetary policy, Geopolitics of financial sovereignty and trading crypto volatility the smart way. Okay, so the rise of digital currencies and CBDC. So, to understand the rise of digital currencies, we first need to accept a very simple reality. Money has already gone digital, okay? You have to accept it, okay? We just haven't fully labeled it that way yet. Most of us don't use cash for daily transactions anymore. I don't know about you guys and where you guys are from. I know we've got people from South Africa, from Australia, Philippines, Malaysia, Singapore. I am based in Singapore, like I said, and I do not have cash on me ever. If you come up to me and be like, can I borrow $10? I'll be like, cash, or can I transfer you the $10? Because I will never have cash because everything here is digital. So we tap our cards, we scan QR codes and send bank transfers. We use apps and move value with numbers on a screen. Sorry, I'm just checking to see if you guys can still hear me. So physical cash is already becoming a niche instrument, okay, not the core system. So when people say digital currencies are the future, I'll argue the future is already here. Okay, it's just being formalized. So historically, money evolved based on trust and efficiency. We moved from barter to gold, from gold to paper, from paper to bank deposits. And now from bank deposits to digital representations of value. Every shift happened because the old system became inefficient or restrictive. So today's system still relies heavily on intermediaries, slow settlement times, cross-border frictions, and outdated infrastructures. Digital currencies emerge as a response to this inefficiency. So what's important to understand is that digital currencies didn't rise because of speculations first. Speculation came after. They rose because technology made it possible to transfer value instantly, globally, and programmably. So blockchain technology removed the need for centralized reconciliation, while cryptography introduced new forms of trust. Whether people love or hate crypto, the underlying shift from physical to digital money is irreversible. So when central banks and governments look at this landscape, they're not asking, should we go digital? They're asking, how do we control and integrate something that's already happening? That's the starting point for understanding both crypto and CBDS. It's not a rebellion phase anymore, okay? It's an evolution phase. And markets are still figuring out what that means. Okay, someone is asking what CBDS stands for. Sorry, if I didn't make it clear, CBDS stands for central bank digital currencies. Give me a sec, guys. Someone's saying there's an echo in the background. Let me try to fix this. Okay, I hope that's better. Sorry, if you guys can see, I am clearly in a different location today, because I am also traveling. It's year end, right? Everyone's traveling. Okay, so back to our webinar. Now let's talk about what CBDS is. Again, central bank digital currencies, because this is where crypto and central banks collide. So CBDS is not Bitcoin, but it's not meant to replace crypto. It's essentially digital versions of existing fiat currency issued directly by a central bank. Same currency, same value, but in a new format. Why are central banks doing this? There are a few big reasons. First, efficiency. CBDS can dramatically reduce settlement times, especially for cross-border payments. Second, financial inclusions. In theory, CBDS can give people access to the financial system without needing traditional bank accounts. And third, and this is the one markets pay attention to, control. CBDS allows central bank to track money flow more precisely, implement targeted stimulus, and even design monetary policy tools that were impossible before. Imagine stimulus that expires if not spent, or direct transfers without intermediaries. From a policy perspective, this is extremely powerful. China's digital yuan is a prime example. It's not about innovation for innovation's sake. It's about maintaining monetary sovereignty, improving payment infrastructures, and reducing reliance on foreign controlled systems. So Europe, the US, and many emerging economies are exploring similar paths, not because they love crypto, but because they don't want to lose control of money creation and circulation. So CBDS are not anti-crypto. They are a response to crypto. They represent the institutionalization of digital money. And once you understand that, you realize that this isn't a fight between old and new. It's a race to define the rules of the next monetary system. This is where things really get interesting. Okay, so let's talk about crypto versus CBDS, the freedom, the control, and the new monetary landscape. Um, because crypto and CBDS represents two very different philosophies of money, crypto essentially, or especially Bitcoin, was built on decentralization. No single authority controls it. Supply is algorithmic and transactions are permissionless. That appeals to people who value independence from governments, banks, and political influence. CBDS are the opposite in structure, but not necessarily in tenant. They are centralized by design. They allow government to enforce rules, manage liquidity, and maintain monetary stability. From a central bank's perspective, this isn't about surveillance. It's about ensuring the financial system works smoothly and remains resilient. What many people get wrong is thinking this is a zero-sum battle, crypto versus CBDS, winners takes all. Okay, that's very, very unlikely. What we're more likely to see is coexistence. Okay. Crypto will continue to exist as an alternate monetary asset, a hedge, a speculative instrument, and a technological experiment. CBDS will exist as the official digital extension of fiat systems. For traders and investors, this matters because it refrains crypto not as a replacement for money, but as a parallel monetary system reacting to central bank policy, liquidity conditions, and trust cycles. So when trust in institutions weakens, crypto narratives strengthens. When policy tightens and regulations increases, crypto volatility rises. So understanding the rise of digital currencies and CBDS is not about picking sides. It's about understanding the forces reshaping money itself and positioning intelligently as markets adapt. Okay, so let's talk about how Bitcoin reacts to monetary policy. One of the biggest misconceptions about Bitcoin, okay, is that it's either a pure risk on asset or a pure safe haven. Okay, in reality, okay, and this is also something I really agree. Okay, Bitcoin doesn't fit neatly into either category. What Bitcoin reacts to most consistently is liquidity, how easy money is, how available capital is, and how restrictive or accommodative monetary policy becomes. When central banks are easing, cutting rates, expanding balance sheets, injecting liquidity, Bitcoin tends to benefit, not because people suddenly believe in decentralization more, but because excess liquidity needs somewhere to go. Historically, some of the strongest Bitcoin rallies have happened during periods of aggressive monetary expansions. When real yields are falling and cash is losing purchasing power, in those environments, Bitcoin gets framed as an alternative monetary asset and hedge against debasement. On the flip side, when central banks tighten policy, raising rates, shrinking balance sheets, draining liquidity, Bitcoin struggles. That's because speculative capital dries up, leverage becomes expensive, and investors reduce exposure to volatile assets. This is why Bitcoin sold off sharply during aggressive Fed tightening cycles. It wasn't a failure of technology, it was a reaction to tightening financial conditions. So when traders ask, is Bitcoin risk off or risk on? I always answer with, okay, it really depends. Context really matters. Okay. So the better question for me is liquidity expanding or contracting? Because Bitcoin trades the liquidity cycle far more cleanly than it trades narratives. Okay, so let's kind of understand rates, real yields, and why Bitcoin cares about the Fed so much. Another critical layer is understanding Bitcoin's reaction to monetary policy is real yields. That is, interest rate adjusted for inflation. Bitcoin doesn't compete with cash, it competes with real returns. Okay, when real yields are high, holding cash or bonds become attractive, and Bitcoin lose less compelling because it doesn't generate yield. This is why periods of rising real yields tend to be negative for Bitcoin. Even if inflation is high, if central banks are raising rates faster, real yields rise, and Bitcoin loses its appeal as an inflation hedge. We saw this very clearly during aggressive Fed tightening phases, where inflation was still elevated, but Bitcoin fell because real yields surge. Conversely, when real yields fall, either because rates are cut or because inflation outpaces rate hikes, Bitcoin tends to perform better. In those environments, holding fiat feels punitive and alternative assets gain traction. This is when Bitcoin narratives around digital gold and store of value starts resonating again. So when watching central banks, don't just look at policy rate, look at inflation expectations, look at bond market, and look at real yields. Bitcoin is extremely sensitive to that triangle. That's why macro traders who understand rates often understand Bitcoin better than pure crypto traders. So let's move on with understanding why Bitcoin often moves before policy changes happens. Oh, by the way, guys, if you guys have any questions, you guys can leave it to the end of the webinar. On Vantage app, I will slowly scroll through later because I think we will end today quite early. I mean, in terms of the slides, and then we can head straight to the Q&A at the end of the session. You guys can just bombard me with whatever questions you guys have. It doesn't even have to be about today's topic. I mean, although today's topic is very interesting, it's about crypto, right? I actually expected more questions today, but I see one or two questions which I'll answer at the end of the webinar because those are not really um urgent right now. But yeah, I would think you guys would have more questions because of crypto. Do you hold any crypto? Okay, yes, I definitely hold a lot of crypto actually. A lot of my portfolio is crypto. Okay, so let's understand why Bitcoin often moves before policy changes happen. Just like Forex and bonds, Bitcoin doesn't wait for central banks to act. It reacts to expectations. When markets start believing that rate cuts are coming or the tightening is near its peak, Bitcoin often starts moving before the first policy change actually happens. This catches a lot of traders off guard because they're waiting for confirmation instead of trading anticipation. So Bitcoin's investor base is highly speculative and highly forward-looking. That makes it very sensitive to changes in tone from central banks, a shift from hawkish to neutral language, or from neutral to dovish guidance. Can be enough to trigger a rally even if rates remained unchanged. This is why you'll sometimes see Bitcoin rally while economic data still looks weak or while policy is still technically tight. The market is trading the next phase of policy, not the current one. The same logic applies in reverse. If markets believe tightening will last longer than expected, Bitcoin can sell off even without new hikes. So when trading Bitcoin around monetary policy, the key skill is not reacting to headlines, it's reading expectations. Watch bond yields, watch central bank language, and watch liquidity conditions. Bitcoin is not disconnected from macro, it's deeply, deeply embedded in it. So we're going to like the next half of the webinar. We're going to talk about geopolitics of financial sovereignty. To understand this, we need to understand that money as power and why finance has become a geopolitical weapon. I did put a picture here of um, the SDR basket, which is, Brazil, Russia, India, China, South Africa, okay, and some of the characteristics of it. So to really understand the geopolitics of financial sovereignty, we need to start with one core idea. Money is not just an economic tool anymore. It is a geopolitical weapon, okay, whether we like it or not. So over the last 2 decades, countries have realized that whoever controls payment systems, reserve currencies, and financial infrastructure holds enormous global influence. This is why access to systems like SWIFT, dollar clearing, and global banking network has become a matter of national security rather than just economics. The clearest example is sanctions. When a country is cut off from global financial system, its economy can be crippled within a single soldier being deployed. Okay, this is without anyone going to war, without any guns. Okay, that realization changed how governments think about money. Suddenly, dependence on another country's currency or payment rails look like a strategic vulnerability. And once finance becomes a weapon, the natural response is to seek independence or at least reduce reliance. This is where the idea of financial sovereignty comes in. Countries want the ability to transact, settle trade, and store value without being fully exposed to foreign control. That doesn't mean abandoning the US dollar overnight. That's unrealistic. But it does mean diversifying reserves, building alternative payment systems, and exploring new forms of money that can operate outside traditional choke points. So for markets, this is really, really huge. Okay, because geopolitical shifts don't move like economic cycles, they move in long arch. And when those arch bend, they reshape capital flows, currency demands, and investor behavior for years. So crypto, CBDS, DCs, and even gold all sit inside this bigger story of control. Okay, so this is where it is where or who controls money in a fragmented world. Okay, so um again, I did put a graph here of how countries are affected. Okay, so we can see trade invoicing, payments, infrastructure, commodity pricing, development, finance, bank deposits, corporate borrowing. Okay, which countries are involved or have a lot of skin in the game. Okay, so As you can see, it's always going to be China because China is a very big country and the economy is very big. That's why I think countries are slowly realizing that currency is power, and therefore they're trying to be more reliant to themselves, especially China. So CBDS, de-dollarization, and the push for monetary independence. When people hear the term de-dollarization, they often imagine a dramatic collapse of the US dollar's dominance. In reality, that's not how it plays out. De-dollarization is not about replacing the dollar tomorrow. It's about reducing exposure over time. Okay, you cannot get rid of the US dollar over time. Okay, and CBDS, okay, one of the tools countries are exploring to do exactly that by issuing central bank digital currencies. Countries can build alternative settlement systems that don't rely entirely on existing dollar-based infrastructure. For example, bilateral trade agreements settled in local currencies, regional payment networks, or digital currencies bridges between central banks. These don't remove the dollar from the system, but they reduce how often it's needed. China's push with the digital yuan fit perfectly into the framework. Okay, it is not about overthrowing the dollar. It's about ensuring China can conduct trade and payments even if geopolitical tensions rise. Other countries are watching closely, especially those that have experience of fear financial sanctions. From a trader's perspective, this doesn't mean the US dollar suddenly collapses, okay? Again, like I said, it's going to be a slow process of changing. In fact, during crisis, the dollar often gets stronger because liquidity and safety still matters, but over the long term, these shifts can slowly erode the dollar's monopoly in certain regions or trade corridors. And that gradual change matters for Forex because it influences reserve allocation, capital flows, and long-term currency demand. So when you hear about CBDS and de-dollarization, don't think revolution, think rebalancing, slow, strategic, and politically driven. So where does crypto fit? This is where um, crypto enters the geopolitical conversation in a very unique way. Unlike fiat currencies, crypto doesn't belong to any one country. Until today, I don't even think we know the origins or who created Bitcoin. So it is borderless, permissionless, and it's neutral by design. That neutrality is exactly why it becomes relevant during periods of geopolitical tension and trust breakdown between nations. So sometimes, okay, a lot of my previous webinars, I always say that if gold is going up in price, usually crypto will drop in price because gold is considered a traditional safe haven asset. Okay, but cryptocurrency is considered a risky asset. But at the same time, if we're looking at the charts of Bitcoin over the many, many years, you can see obviously Bitcoin is at like, let me check the price of Bitcoin right now. Bitcoin is like at $86,000. Okay, how did it get from $86,000 over 2009 over the last 20 years? How did it get there? Because it is going up. Like I said, whenever there is periods of geopolitical tension, people don't trust nations. They kind of run a bit to crypto, but that's obviously not the whole world. It's going to be a certain group of people. Okay, so when people worry about capital controls, sanctions, and restricted access to financial systems, crypto narratives strengthens. Not necessarily because everyone suddenly wants to use Bitcoin for daily transaction, but because it represents an exit option. A system that operates outside traditional political frameworks. That's why you often see spikes in crypto interest during geopolitical crisis, even if the long-term trend remains volatile. Okay, at the same time, crypto's volatility is also a reflection of its position in the geopolitical tug of war. It's not fully embraced by states, not fully detached from regulation, and still heavily influenced by global liquidity conditions. That makes it extremely sensitive to shifts in policy, power dynamics, and enforcement signals. For traders, this means crypto often acts like a pressure gauge. Rising geopolitical stress can boost interest and speculative flows, but tightening regulations of monetary policies can quickly reverse those moves. Crypto doesn't replace fiat or CBDCs. Okay, it exists alongside them as an alternative system that respond to trust, control, and sovereignty dynamics. So, in the context of financial sovereignty, crypto is neither a hero nor a villain. Like I said, again, no matter what topic we're on, it can be gold, it can be oil, it can be crypto, it can be fiat, whatever it is. We just need to remember context is important. Okay, it's a mirror. It's always reflecting how fragmented uncertainty and political charged the global monetary system has become. Okay, so I would have to say if you believe in Bitcoin, then you're going to believe it all the way. If you don't, then I do recommend that you try to research on it. Okay, if crypto is something you don't already invest in. I personally really believe in cryptocurrency because, again, of how decentralized it is. Like countries are out to kill each other. So once they're done killing each other, whose currency is going to win? So therefore, I'm not saying that I'm all in on crypto, but I think I know people who are crazy about crypto, right? If they have $10, they put $9 in crypto and $1 they spend for their own living expenses, but that's not me. Okay, so if I have $10, I put $2 in crypto. So I have some exposure in crypto. Okay, sorry, maybe I put $4 in crypto. I have some exposure to crypto, but I'm not all in on crypto. Although I think it is the future, I don't think like the future is uncertain, right? I believe strongly that it is the future, but I don't recommend anyone going all in into something. Okay. Always diversify, always put your eggs in different baskets because it is dangerous, okay, to put everything in one basket. If you put everything in one basket, you can either go crazy rich or you can lose everything. Okay, so for me, I don't like to gamble that way. It's very dangerous. Therefore, I do have some exposure to crypto. My portfolio has quite a bit of crypto in it, but not all of my portfolio is in crypto. Okay, so I'm going into the last part of today's webinar, which is okay. I see questions here. Sorry, I missed some of your questions because you guys asked in the Q&A box. I pulled out the chat box. I didn't pull out the Q&A box. Does BTC 4-year cycle has an impact on crypto prices? Is it more on the 50 side? Yeah, it's long-term investment potential for crypto operation. Why does better hold crypto? Okay, I will answer you guys. I'm on the last few slides, and then we can go on the Q&A questions, the questions and answers part of this webinar. Okay, and yeah, other than that, I do see a few more questions here. Hey, Cass. Okay, I'll come back to you guys after we are done with this part. It's just 3 slides and then we are basically done. Okay, so let's understand why crypto volatility exists and why it's not random. Okay, to trade crypto volatility intelligently. Okay, that being said, right? That being said, let me just clarify first. When I say it's not random, I'm talking a lot about like Bitcoin. I'm talking a lot about Ethereum, maybe. Okay, maybe Bitcoin and Ethereum. But when we're talking about the other cryptocurrencies, when we're talking about like all the meme coins, right? No, those probably move in random. Those you can get burned really easily with those, but I'm talking more on like Bitcoin. Okay, so to trade crypto volatility intelligently, the first thing we must do is to stop treating volatility as chaos. Okay, so crypto volatility exists for a specific structural reason. And once you understand those reasons, the price actions become far less intimidating. Compared to Forex or bond markets, crypto is still relatively small in market size. Okay. I do have people asking me, can I still invest in crypto? Actually, someone just asked me yesterday, or was it the day before? Like, this is a close friend. I haven't seen him in years, and then I met him for drinks and he asked me like, I just bought crypto, I just bought Bitcoin. Am I too late in the game? It's already so expensive. No, you are actually not late in Bitcoin because first of all, I think the high of Bitcoin was 100,000, 110,000, and today it is at 86,000. So Bitcoin has pulled back a little bit. It is dropping because price is constantly moving up and correcting itself. So we are in the correction phase, and I again, do not take this as a signal to buy or sell, but I personally see it as a discount and a good opportunity for me to enter because it is discounted. Okay, so that's my own take on Bitcoin. Okay, so crypto volatility again exists because of structural reasons. Uh, you can use technical analysis for Bitcoin and Ethereum. I've been using technical analysis on Ethereum and it works. It works. Okay, so what it means that it takes less capital to move prices because the market size is still not relatively very big. And when sentiment shifts, those moves can be exaggerated very quickly. Another major driver is leverage. Crypto markets are heavily leveraged, especially through perpetual futures. When prices move, forced liquidations amplify the move, not because fundamentals suddenly change, but because positions are being mechanically closed. This is why you see sharp vertical moves that look crazy on the charts. In reality, they're just leverage flushing out of the system. Narratives also travel faster in crypto than in traditional markets. A change in Fed tone, a regulatory headline, or a geopolitical event can immediately trigger a new narrative, and crypto trades that narrative aggressively. This makes volatility cluster around expectations shifts rather than data releases. So volatility in crypto is not random. It is a result of liquidity sensitivity, leverage structure, and narrative-driven positioning. Once traders stop fearing volatility and start understanding its source, it becomes something to work with rather than something to avoid. So timing does matter when volatility is tradable is one thing to understand, and when it is a trap, it is also one thing to understand. So not all volatility is tradable, and this is where many traders get hurt. The best crypto volatility occurs after expectations have shifted, not while the market is still confused. I mean, that's the same for everything, right? It's not just crypto, it can be stocks, it can be Forex. Okay, so for example, when the market clearly believes rate cuts are coming and liquidity expectations improve, volatility expands in a directional way. That's good volatility. It trends, it respects structure, and it gives you follow through. The worst volatility happens during uncertainty, as we all know it. When the market doesn't know whether policy will tighten or ease, whether regulations will clamp down or loosen, or whether liquidity will expand or contract, crypto becomes choppy, whippy, and emotionally violent. That's when traders overtrade, get chopped up, and lose discipline. Smart traders wait for alignment. They want central bank expectations, bond yields, and liquidity signals pointing in the same direction. When those align, crypto volatility becomes tradable because it has a directional bias. Without that alignment, volatility is just noise. So the key skill isn't predicting volatility, it's knowing when to participate and when to step aside. In crypto, patience is often more profitable than activity. I can tell you that much because I am someone who has made quite a substantial amount from trading crypto. So it's like finding the balance, right? Because moving fast will help you uh know when to exit. So I think I've shared this story with you guys before. I've actually, at one point, I was about 250,000 or $300,000 profit. We're talking about US dollars, by the way, profit in cryptocurrency. Okay, but within one short week or one a few 2 days actually, within 2 days, I lost 100,000 from my 300,000 profit. So what happened is that I patiently waited for that profit, but I got wiped out overnight. So it is finding a balance. You do need to patiently wait for a profit, but you do need to know when to get out. Okay, but that is just the same for anything. It doesn't have to be crypto. Okay, so I see more questions coming in. Give me a sec, guys. This is the last slide, and then we can go straight into the Q&A. Okay, so smart positioning, survival, volatility without overtrading. The smartest way to trade crypto volatility is not to try to outsmart it, but to respect it. That starts with diversifying your portfolio, okay, and then position sizing. Crypto does not reward oversized position. Okay, smaller size with wider stops allow you to stay in trades without getting shaken out by normal volatility. If your size forces you to micromanage every candle, you're already positioned incorrectly. Okay, time frame selection also matters. Crypto destroys short-term traders during volatile phases because lower time frames are dominated by liquidation flows and noise. Higher time frames 4 hour, daily, even weekly, smooth out that noise and allow you to trade the underlying macro and liquidity trend. Another key mistake traders make is feeling the need to always be in the market. Okay, that's why emotional management and discipline is so important. Crypto trades 24/7. Okay, there is no need to chase crypto. Okay, it trades 24/7, but you don't need to trade 24/7. The best crypto traders are very selective. They wait for conditions where volatility expands in their favor, not against them. Ultimately, trading crypto volatility the smart way is about discipline, alignment, and survival. Volatility is not your enemy, poor positioning is. If you align with liquidity cycles, respect leverage dynamics, and manage risk intelligently, crypto volatility becomes a powerful opportunity rather than a constant threat. And that's the mindset shift that separates traders who last from traders who get burned out. Okay, so I'm done. Let me answer some of your questions. Just give me a sec. Wait, I'm just making sure that the Vantage side is okay. Okay, so where were we? There's quite a bit of questions actually. I wanted to leave it to the end so that I can really focus and really think about the answer. Okay, so Cass, the first one, Cass. So the bottom line is Bitcoin actually competing with central banks, or is that a narrative a bit exaggerated? Okay, thank you for asking. I'd say that it isn't exaggeration. Like I said earlier on, it's not really a competition, it's more like a coexistence. Okay, Bitcoin isn't replacing central bank. It does react to what central banks do. So it's more like a parallel system. Okay, so it's not competition. Okay. Another question, why does Bitcoin sometimes dump even when inflation is high? Isn't it supposed to be an inflation hedge? Okay, this is a very common misunderstanding. I don't know if it's something that you guys misunderstood as well from what I said. So Bitcoin isn't a inflation hedge by default. Like I said, everything is always context, 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 context. It's a liquidity hedge. So if inflation is high but rates are rising faster, real yields go up and Bitcoin actually gets pressure. Bitcoin performs best when inflation is high and monetary policy is loose, or when real yields are falling. Okay, so you always need to look at the policy response, not inflation alone. Context is important. Context is very, very important. Okay, another question here. Does BTC 4-year cycle still have impact on crypto prices, or is it more now about liquidity since institutions have introduced crypto? Okay, good question. The 4-year cycle still matters. It's not as dominant as before. It used to drive almost everything because the market is mostly retail and supply driven. Now, with ETFs and institutions involved, liquidity and macro conditions matter more. So I would say the cycle still provides a background rhythm, but the volume knob again is liquidity. So when liquidity is loose, the cycle works better. Liquidity is tight. Even a bull cycle can under. Okay, I got another question here. In terms of long-term investment and potential for capital appreciation, which one is better to hold? Crypto coins, crypto, where was I reading from? Why did it move? Which one is better to hold, crypto coins or ETFs? Okay, so the short answer is it depends on what you're optimizing for. Okay, if you're looking to maximize upside and capital appreciation, crypto coins still have higher potential because they're more volatile and earlier in the adoption curve. But the upside comes with bigger drawdowns and higher risk. ETFs are better for long-term stability, accessibility, and institutional style holding. Okay, so I hope that answers your question. I mean, okay, so back to the last question. So realistically, it's not either or. Crypto coins are asymmetric upside. ETFs are structured long-term exposure. So the best approach, in my opinion, okay, or for most people, is to mix. Okay, sized according to risk tolerance. Someone asking here, would you recommend investing in good projects? Hi, can you guys hear me now? Can you guys hear me? Let me know in the chat box if you guys can hear me. Okay, which question did I not answer? So did you guys hear me answer, does BTC 4-year cycle still has impact on crypto prices, or is it more about liquidity since institutions have introduced crypto ETFs? Okay, you guys heard that. I'm moving on to the next question. Both we heard. Okay, cool. I'm gonna answer the next question now. Would you recommend investing in good Would you recommend investing in good projects, new coins before they are listed in exchange like IPO, or should we just focus more on tried or and tested crypto like BTC, ETH, and so? Okay, this is my own personal opinion. Personally, I see those as two different strategies. Okay, investing in new projects before listing is like venture capital. The upside can be huge, but the failure rate is also very high, and liquidity risk is real. So most people underestimate how many of these projects never really go anywhere. Actually, I've seen so many shoot up and then like just burst. So I mean, I personally, this is my own personal answer, okay? It may not be of all crypto traders or everyone out there, but I personally would not trade new launch because I don't want to take that kind of risk. So I personally, I only trade BTC and ETH. But if you guys have that kind of risk appetite, definitely go for it. It's something, like I said, it's like venture capital. Okay, next question. Some experts predict BTC will reach 500,000 or 1 million per coin in the future. What do you think is the reason some whales sold their BTC holdings in October and November? Okay, yes. So even if people believe in a very high long-term target like 500,000 or 1 million, whales don't trade the belief. They trade positioning and cycles. A lot of the selling in October and November was simply profit taking after a long, strong run up, especially with ETFs bringing in new liquidity. Whales also rebalance when macro uncertainty rises. So higher yields, policy risk, and year-end positioning. Okay, it doesn't mean that they're bearish long term. It usually means that they're just taking profit and then they will later re-enter. I personally also got out in my Ethereum trade. I don't know if you guys have been following. Well, I mean, you guys haven't been following me for a long time. I only started taking you guys this year. I got out of Ethereum at let me see, what 4,400. I got out of Ethereum at 4,400 in September actually, and I'm just waiting for price to drop right now. I'm just waiting for price to drop, give me a discount, and I will re-enter Ethereum. So people could just be taking profit. Actually, that's around the time people taking whales sold their BTC holding in October and November. Yeah, that was a perfect time to be taking profit, to be honest, because that was really close to the high. And they take profit. Now they're just waiting for the discount. They're just waiting for things to come back down, and then I'm very sure they will re-enter again. Okay, so yeah, I hope I answered most of your questions. If you guys Okay, I have another question here. Does CBDS means government are trying to kill crypto? Okay, not really. CBDS aren't about killing crypto. They're about more money modernizing fiat and keeping control of the monetary system. This way, right? Because with CBDS, the government and countries get to like track transactions easily. People cannot like avoid taxes anymore. I don't know about the countries you guys are from, but I know where I grew up from, people would prefer taking payment in cash because they don't need to like declare their income and therefore they don't need to pay for taxes. Okay, so when things are going digital, everything can be traced, everything can be tracked. So I won't say they're doing it to destroy crypto. I think they're doing it to modernize the financial systems in their own respective countries. Okay, so I hope I answered most of your question. Thanks for joining my webinar this week. I'll see you guys next week. Oh, wait. Yes, I will see you guys next week. Sorry, I thought it was canceled for the holidays. No, no, no. It's not canceled. I will see you guys next week. So same time next week, Tuesday, a different topic about economy, microeconomy, geopolitics, currencies or whatever it is. Again, I used to do technical analysis for you guys, but I have been requested by Vantage to don't not to do technical analysis for you guys because I think we have other webinars on technical analysis already. There's too many webinars on technical analysis. So now I am in charge of like economics, macroeconomics, microeconomics, geopolitical tensions, basically just anything to do with trading, right? Okay, so I will see you guys next week. Thanks for joining. Thanks, Tiffany. Thanks, Karsten, Eula, Helen, the 1,200 of you on the Vantage app. And I will see the rest of you next week. Bye. Take care.